Hi there, I'm James Osborne, the co-founder of the Recruitment Network, and this is the TRN podcast. Every week, we unpack the strategies, the technologies, the processes and mindsets fueling today's top-performing recruitment agencies. We take a look behind the scenes of some great recruitment businesses. We listen to the real-life stories of those who have built those businesses, and we learn from some of the industry's greatest thought leaders to help you become both future fit and future relevant. So let's begin with this next episode of the TRM podcast. Okay, good stuff. Right, let's get going with it now. So firstly, thank you for coming along today. Lovely to see you all. Thank you for those of you listening back to the recorded version of today's session as well. My name is James Osborne. I'm the chairman and co-founder of the Recruitment Network. If you're not familiar with the Recruitment Network, or TRN as we like to describe it, we are a large global community of both recruitment business leaders and also recruitment advisors and mentors. And we all hang out together and help each other maximize performance, profitability, and productivity. And in particular about enabling recruitment organizations and founders to build and hopefully realize some shareholder value as well. So today's session, we're running it slightly differently from our normal sessions. We're doing a panel session today, and we're going to focus on how to master your exit strategy, and whether that's looking at an MBO, whether it's looking about how to prepare your business for an exit of some form of capital event, or it might even be just actually just want to future-proof your recruitment business for that matter as well. So we thought we'd bring along a panel of experts today, as always. Good friends of TRN, good friends of mine who've got some real world insights, I suppose, into this process. They've got the battle tested strategies and scars on how to build and plan for a successful exit in some format. So we're going to explore lots of different areas of this today, from sort of the process you follow to get there through to different types of exit and capital events and everywhere in between. If you have any questions at any stage, I think we just put it in the chat. Please feel free to drop them into the chat or put them into the Q&A section, and we'll make sure we get those questions answered. And if you're obviously listening to the recorded version back and you've got some questions retrospectively, then ping them across to us at TRN and we'll get them answered for you as well. Just a very quick introduction of our three guests, no particular order, so I'm going to do it based on the order that you are on my screen, not favoritism here whatsoever. So I'll start with Mike Gawthorne. Mike's one of the TRN strategic advisors, chairman of TRM, former CEO of ARM and Seracor Group, and Mike led a £120 million turnover business through to a successful MBO. Toni Cocozza, also a TRN strategic advisor and one of the nicest people I've ever met in my entire life, who founded and grew and steered an award-winning recruitment business, DP Connect, and took that through to a very lucrative MBO herself. And then on the other side of the fence, we've got Rowan Grobler, who's one of the TRN partners, Chief Financial Officer, CFO, investor with expertise in private equity, M&A, and helping SMEs go through a funding process or achieving some form of profitable sale. And he's managing director at K3 Advantage. So firstly, Rowan, Toni, Mike, thank you very much for your time today. Thanks for joining us today. Great to see you all, as always, and I hope I've introduced you all correctly. Let's go straight into it. We'll sort of set the scene a little bit here, I suppose. And I'm going to go straight into probably Toni to kick us off, actually. Toni, when we talk about going through to an event in a recruitment business, and I know you did yours through an MBO, what is it that motivates you to do it? What is it that motivates you, A, to go on that journey, and then B, to maybe go down the MBO route potentially, rather than doing a traditional trade sale or any other form of external investment?
Okay, well, I'd ran DP Connect for 28 years by the time I did my MBO. So I'd had some absolutely amazing years over that time, and I'd had some absolute shockers, ups and downs all the way along. And what had happened during that journey was most probably every 7 to 10 years, somebody had come along and made me a wonderful offer to buy my business when it was going really, really well. And of course, at that point, I was like, well, if you can give me that much money, how much more can I make? And I would say that I actually sold it at the end for less than what had actually been offered a couple of times previously. And the situation was I wasn't really ready to do an exit. I didn't really know what my business should look like to do an exit. But over those years, I sort of learned why people would tell me things about my business were good. Different strands of business that I was doing, the amount of contractors I was running, the amount of cash I had in my business, and ultimately the amount of profit that I had. And every time I wanted to sell my business was on a downer. It was when we weren't doing very well and the market was really tough. And in the end, I think I got to a stage where the business was doing okay when I sold it. It was all right. It was doing well. I could have carried on. But I'd ran it for 28 years and the market's changed. I'm not getting any younger, and I just felt that it needed fresh blood. And I kept on hitting a ceiling around the 30 million turnover, and I couldn't break it. So it would go up and down at that level, and I really wanted the business to go forward. So at the time, I looked at the options of either doing an MBO or going for a trade sale. On hindsight, I think I'm not sure I made the right decision as such, because I don't think I explored enough the trade sale. And I think ultimately I would have financially done better doing a trade sale at the time. I think some of the things around doing an MBO, which I didn't realise was, I expected if I do the MBO, it's better for everybody that's worked here for me. A lot of people had worked with me for over 20 years, so I really wanted to make sure that my personal success of selling the business didn't upset anybody else, and that people still had their jobs and that they'd be happy and they'd understand the environment. So by doing the MBO, I thought that people would stay longer within the business. I thought they'd be secured in, and that wasn't actually the case. Within 18 months of the sale, a lot of people had left the business. So I think that's something I'd say, keep in mind. I don't think the party that actually did the sale and that bought the company really tied anybody in enough. I think they thought that they would just stay because they'd been there a long time. So I think there's a real piece around that. However, it was, it went successfully for me for a certain part, but there were a few horror stories afterwards. I won't go into them now.
And Toni, do you find that when you went on that journey, it got to a point, and I don't want to say this the wrong way, but where you felt that you've almost done all you can for your business and it needed someone else or something else to take it to that next stage?
Yeah, it needed new eyes. It was just, I had a good team in there. I had a really strong team. I employed some of the best people in the industry. I didn't always keep them, but it needed more than just what I could bring at that time. I think it needed fresh eyes. It needed fresh blood. It needed change.
Okay. And Mike, to do that and to accept that, and I'm really, obviously, I know your journey, and I love to hear it, love you say it to everyone here, but to do that is quite an emotional thing to do, isn't it? I mean, you often talk about the expression of it's your baby, and then suddenly letting go of your baby sort of stuff, or or even not even letting go of your baby, giving your baby literally to somebody else to go and look after. So tell us about the Cerecore story, and I suppose as much from a sort of a process as much as it is from an emotional journey as well.
So I joined, ARM was a very small business when I joined. It was four or five people. I joined in 2000, invested in the organisation. We then grew the company, myself and my business partner, through to 2005, which is when we had our first event and we brought venture capitalists in to exit a private shareholder. So I had VCs involved in my business for about 4 years, something like that. Did a bank back buyout just as a recession hit in 2009, which was wonderful. So kind of sat there holding the baby going, right, I've got a load of debt now, how do we service it? And then 2009 grew the business successfully throughout the recession because we backed the right industry sectors and customers. And then created a group structure in 2013, and then finally exited through a management buyout, which was sort of alternative debt, banking backed for my leadership team, which I brought in. So the emotional journey was, and Toni, the things that Toni just talked about, we had so many approaches over the years from companies saying, oh, we want to buy your business, this, that, and everything else, had PE sniffing around all over the place, and large corporates wanting to buy the organisation. But I always wanted to try and keep the brand and always keep it with leadership. And we had EMI schemes running in the business, so I wanted people to realise value out of that as well as then rolling over into the next section of growth. And it was fascinating from the point of view in terms of my hard stop was my 20-year anniversary. So I exited November 2020, and without that hard stop, I wouldn't have made it happen, because I said 20 years, I'm out, I'm done. But also because it was the right thing for the business. I had felt that I had taken the business as far as I possibly could with my capability. So I got to a point where effectively I felt that I couldn't operate in a larger organisation with more politics. We had 225 people. I was starting to strain at wanting to know every single person's name, their partners, their families, everything that made them tick. So I know that my sweet spot is more smaller organisations from sort of 30 through to probably 120, 150, and that's my sweet spot. And to be quite frank, that's when I enjoyed it most. So for me, the emotional journey was highs and lows, not enjoying it, thinking I wanted to realize value probably for the wrong reasons. But on the same thing with Toni was, for me, it was the right time for me personally. And until you put that stake in the ground, what you find is there's not that driving force. Because if you're an owner manager, you think, oh, I'll go another year, I'll go another year, and especially if it's going like that, you think, actually, I'll just go another year. And then all of a sudden things drop off. But one of the things you want to do is you want to go when there's an upward trajectory, whether it be MBO or it be trade sale. You've got to leave plenty in the tank for the next set of management or whoever's taking it over, so you can sit back with pride and go, I've started that next course of journey for them. But it's very much an emotional roller coaster.
It's a really interesting point, because a lot of recruitment leaders that obviously we speak to across TRN and outside, they're always looking to get the business to that pinnacle point, but actually that's almost too late at that point, because there's nothing left to play with, right? So as you say, it's getting the business geared up so it's ready to go to that next stage and then take a step back from it, sort of thing. Rowan, from your point of view, obviously this is from Mike and Toni's perspective, is from an owner's point of view and when it was right for them. From an investor's perspective, how do you typically assess at what point a recruitment business is sort of ready to do something, whether it be operationally, culturally, whatever it might be, to go through that process?
Yeah, I think it's Mike's brought up a really valid point, which I find that some management teams often miss out on, is leaving something on the table for an investor or for a buyer to tap into. Selling it right at the pinnacle doesn't leave anything there, and there's no value, because what a buyer is going to be buying is your forward earnings, not what you've done in the past. So selling it while you're still on the up is a key thing to look for within your business. So when things are going right, that's the time to start thinking about a sale. So that's the first point. I suppose the second point, especially when doing an MBO, is concentrating on making sure that you have the correct management team in place behind you. Investors are very, very good at understanding what role the current owner has within the business, and will he or she be critical to that business going forward. Now, invariably in the recruitment world, it is quite critical. So having that handover or that transfer of knowledge and transfer of relationships is really, really important to the new management team. So that's probably the second thing. And then the third thing to understand, and it probably ties back into the first, is just to have alignment with the buyer. Alignment is around, is there a shared common goal? Is there a shared view of where the business can go? Is there a shared view around the business plan? Because if the buyer or the investor doesn't share that same view that the management team have, there will be disconnects at boardroom level, and that is not a healthy place to start. At the start of the journey is probably the best part of the journey, and you will go through teething and you will go through some hard times, but there will be some upsides as well. So those are probably the three things that sort of the highlights that I'll probably pick out amongst a myriad of other things that investors look for.
Fantastic. And just to go a little bit deeper into that, Rowan, for a second, and I'll open this to Rowan and then to the rest of the panel. The Kamar asked an interesting question around, do you have to have a contract business in order to be able to exit? So have you got some form of recurring revenue, annuity revenue, contract book, and that's the only way to sell a recruitment business? When you look at, and we've often talked, I call them the sort of the top 16 things that drive the PE multiple, and these are the sort of the 16 things I think have the biggest impact on that multiple. What would you say are sort of and in this current market in particular, the sort of top 3 or 4 things that a recruitment business has to have to be an attractive proposition for an investor or as a future growth business? I'll start with that. And does that include obviously contract and annuity?
So I mean, I think contract annuity income is obviously is the place to be, because what you do is you're buying into a standard set or a recurring revenue base, and that's really attractive, and that's what gives you an uptick on the multiple. The second thing is also margin. Margin is always helpful, and driving margin northwards, or showing that you can drive a margin northwards is also a strong indicator, and something that will drive multiple. Then also size and diversification across your business. Those are key points to actually delve into when trying to build a business that is set for scale, set for sale, trying to achieve its best margin. I'd be interested to hear a little bit of Mike and Toni's journey in terms of how they thought about building their business and setting it up ready for a sale, and sort of what went through their minds on that journey.
I think for me, it was mainly, I don't know if I thought about it or it was why I was being told we were attractive. We definitely had a large contract base, and that was something that everybody was interested in. We had a lot of cash in the business. We had, we specialised in technology, but we were really doing well in the payment sector at the time, and that was really a good market to be in, and that was very attractive to people. Plus, we'd also had what we called an outsourcing division. Nowadays, I think you'd call it statement of works. So we had a part of the business that had reoccurring revenue coming in from clients on a 3-year contract over 3 really large players. I think everybody loved the size of our clients, the long-term relationships that we've had with those clients, and ultimately, as you said, that we were making a lot of profit and that our team were a strong team.
Yeah, I'm going to go with what I think really doesn't look attractive to investors, banks, PE, VC, wherever it may be. First thing would be huge client concentration. So if you've got, 50%, even 30%, 20% of your book, whether that be perm or contract coming from one customer, they get really nervous. If you're trying to get a bank-backed MBO away, the bank becomes really nervous about concentration. They get very nervous as well around concentration of billers. I've looked at so many companies over the last 4 years where you go in and actually you see that there's 2 key billers. That's huge risk. That's a huge risk. You can mitigate it, but at the same time, any backers, whoever they are, will start to challenge that. I think reliance on individuals, not having clear roles and responsibilities, who does what, but underlying all of this for me would be financial and commercial management. The amount of companies that are making very good money, but actually they have no commercial management or financial management and reporting structures in place, switches people off straight away. So if you're looking to de-risk, for example, through maybe taking some debt into the business, and it's a quasi MBO and it's banked by the bank, don't over or underestimate the importance the bank will have in terms of the credibility of the numbers, the business plans you've put in place and you hitting them, but also your control of financial metrics. So cash management, Tony, the point on cash. Lots of businesses like businesses that have piles of cash in there because they can do something with it. Okay. But actually, you've got to know what the cash is. You've got to know where it is, what your working capital is, what your debtor days are, the DSO counts. All this stuff needs to be brought into play. Just one last thing on that recurring revenue piece. In the last couple of years, I've done a couple of deals as well, where effectively it doesn't have to be a contract book. In my day, it was you need lots of contracts. Okay, 75, 25 contract. Your cost base is covered by a contract. Perm is gravy on top of it. That would get you your MBO. It will get you away. It's a good structure. But actually, more and more now, I'm seeing around more complexity of perm margins and also in terms of the perm billing. So if it can be shown as a recurring book, whether that's retainers, whether that's linked to size of accounts that you're supporting and showing you concentration spread, etc. I think those things can enable you, especially if you're in a niche, and the niche is the key piece, help with that, a reason why that business is backable. And it doesn't just need to be, I've got a contract book.
And that's why it's so important, isn't it, when you're working with your customers on a perm side, that you lock them in on contracts, you lock them in on long-term relationships, because it's not just about a sensible business and it's sort of de-risking what you're doing. It's valuable as well from that point of view. So I think you can almost create that recurring revenue from a contract book in your perm book quite nicely in today's market. Yeah. A couple of questions have come up and they sort of talk to the same point, and this links back into this, because I know if you look at one of the things that investors or anyone would be looking for in that next phase is, well, what's going to happen to the leadership team behind? Are they locked in? Are they tied in? A couple of people asking around about sort of different types of share schemes. So should we have a growth shares or EMI or share option scheme? So I'd be interested in your opinions about that, and also what you did on around that and what happened afterwards. And then the second point to that is around, well, what happens to the sort of the tie-in process for some of those senior people within the business to make sure that the business doesn't really fall apart once you leave, type of thing, I suppose, is the way to look at that. Toni, I'll start with you. But what did you do around that within the business at DP Connect?
Okay, so mine was very old-fashioned. There were certain people in the business that were on long-term investment plans, really. If the business was to get away, that was when they were going to get their payout. I think what didn't happen was, I don't think when the deal went through, the new owner signed anybody in to stay that period afterwards, and people that have been in the business for a long, long time, for whatever reason, left, and that did cause some problems over the first sort of 18 months.
So basically, their payout was attractive enough to not to really require them to stay, and then they.
Yeah, I don't know if it's that. I don't think there was any new carrot on the other side. And something I now recommend to a lot of my clients is that they make sure that there's something post sale as well that keeps those people tied in. Because in my situation, I got 2/3 of my money up front, and then I had loan notes on a period afterwards, and I walked away from the business on the day that the deal went through, and in hindsight that didn't allow me any control at all over that third part of my money, and lots of things happened there that I didn't end up getting all of it, which is something I say to people as well. If there's something on the table, you don't always get it, and whatever those reasons are. So I think it's about definitely getting more people tied in earlier. I think I didn't really know a lot around shares. I mean, I was quite naive to all of that, and EMI schemes and everything. We didn't have anything like that put in place. So I think it's a really, really important thing to get your team with you up to the final day. I mean, we actually had a team, a really strong team in the business, were actually headhunted out of the business a week before the deal went through. And I thought, oh my God, that's it. I finally got around to it. I'm going next Friday. I'm out of this business. And a team resigned. And I didn't think the deal would go through. But because they were a contract team, we kept the contractors. They could pick the work up. Everybody involved was happy to go ahead.
Yeah. So operationally, the business was stronger than the individual people within the business, which is obviously key to that. And then, Mike, from your point of view, then, what was the sort of tie-in process for the senior people within Seracor?
Well, so obviously sensitivity around this, but senior people, they were leading the MBO, so it was in their interests. What I would say is, just talking around this in terms of, I totally agree with Toni. What next? What comes afterwards? What is that? Because you can have the event happen. We've got an MBO, brilliant, everything else, or an event's happen with a backup. But actually, now what's the next set of journeys? So I think, again, when I've advised companies now, it's very much have a clear vision of what happens afterwards. So what's the 3-year journey? What's the value realization? How might people create wealth out of that next stage of growth? Bearing in mind that typically it will be debt in the business. Therefore, they've got to service the debt as well as then grow over the top of it. But I think, for me, equity that actually has some reality is critical. So having an EMI scheme, which is just always on the never, never, doesn't last very long. People will get cynical to it. If you've got a plan and you can show them that this is the plan that we're going to work to, with caveats around it, but what it might mean to them and how they're helping to shift the value of the business is critical. If I think back to my journey, my management team that I needed to conduct an MBO, I started putting in place 3.5, 4 years before it actually happened. That composition of managing director, operations officer, FD, that was my succession plan for the main board. That team came in, and that was not maximizing profitability, because that was a cost, so we were already investing in additional headcount that was a cost base, but because we wanted to do, or I wanted to do an MBO. Now that is where then you take those guys on the journey. So on Rowan's point earlier, my relationship with the bank became the relationship the bank of the COO. Now that was primary relationship that I had, but I had to start handing those things over a 12-month, 18-month journey beforehand. primary advisors, getting people like Rowan and others to actually spend time with that management team to explain how an MBO might work, explaining what VC money is, what PE money is, how it operates, so that you are taking them on a journey with you, but also shares. Because the last thing you want is that effectively the deal's done and they kind of sit there and go, don't really understand it, don't get the structure, and now I don't know how to put structure in place for other people. And that's the key thing for me, is how do you get the maximum lock-in, not only to the team that are leading it, but the team below it. And that's where LTIPs, EMIs, growth shares, etc., have to be really clearly painted on what it could mean to them.
Yeah, absolutely.
I think just going into that, James, the advisors, getting the right advisors is really important. I had okay advisors, but if anything, I was a bit tight, and that didn't help me. I think especially around the person that's buying your business, or that deal going forward, because I don't think there was enough cash left in my business or put into the business to take it where it needed to be to release the dream that they had.
Yeah, no, absolutely. And I think that, surrounding yourself with those people, whether it be a tax advice, but whatever, is critically important. Mike, you touched on a couple of things, and I just want to go back to this to Rowan, because I know both Mike and Toni have gone through the MBOs, but you've also been involved with organisations with private equity and everything else as well. Rowan, just for people listening into this, can you just explain, I suppose, what it's like to have a relationship with private equity world in comparison to maybe a VC world, or to an MBO world type stuff, because it's all quite different, isn't it? And some recruitment leaders aren't prepared for what's going to come next on their next stage of the journey necessarily. Probably don't want it or don't like it, for that matter.
I'd probably separate them into you've got let's call it equity, and then you got debt. So your funders and your banks will be generally quite they at the point of a transaction, they'll be really in your business, and they'll be trying to understand exactly how the business operates, and they will try to get to the grips at a very fundamental level. Once the deal's done, you'll probably only hear from them when things are going wrong. So you always have to give them quarterly information. My advice is always to stay close to the bank. I mean, Mike was talking about having those relationships and really owning them. Always having the bank on side is always a good thing to have, because there are times where covenants do get tight, and understanding and having an open conversation with the bank early doors puts you on the front foot if you need to go and get extensions or covenant waivers or whatever the case may be if things start getting tight. So that's on the debt side. When you talk about the equity, you can probably separate it into two parts. One is venture capital, VC, and the other PE, which also does MBO. On the VC side, again, VCs are backing management teams. They're backing the individual. It's a lot more earlier stage. They're looking for a lot higher growth businesses, less concerned about profitability, although that is becoming more and more front and center over the last 5 to 7 years. But primarily focused on growing that customer base and the customer engine, so that can be sold to a bigger party or a trade where there is a capital uplift. Generally, those deals don't have a lot of debt within them. They're more equity-based, and you often don't necessarily see the investor or that VC investor that often. They've got a wide portfolio, so they generally are quite hands-off, but are available if you want to tap into the expertise. Generally, introductions to people, introductions to advisors and the like. When it comes to private equity, it's a little bit more hands-on, and they will be really forensically involved in your business at the point of transaction, but also on an ongoing basis will be involved within the business. Now, depending on the partner, it depends on your appetite for how involved you want that equity partner to be. Some people I just need some money and some introductions. Let me run my business. Some private equity funds are very much like it. We back management teams. You guys get on with it. We will be there. There are other teams who are a lot more hands-on and help businesses along on the journey because they need that helping hand, or they would like that helping hand. So in both instances, having a really close relationship with your investor is really, really important. And one of the key things over the years that I've done it on both sides of the table, open and honesty for the boardroom is the number one way to operate. And one of the things an investor does not like is surprises. They do not. And one thing they also do not like is management teams pulling the wool over the eyes at a board meeting, masking what's actually going on the ground. Because if you catch things early enough, you're actually able to help them out. And most equity providers are there to help out. It's when they don't know, that's when things get a little bit more dicey. So my one recommendation is have a really good relationship with your equity partner, but share the warts and all version as and when they happen, because it becomes a much more open relationship. And the trust then is, if someone says everything's fine, then it's fine. And if it's not fine, or if they say it's not fine, then you know that you need to spend a little bit more time in the business.
Absolutely. Mike, I know you've got an opinion about this.
Oh, I certainly have. My first foray with VC back in 2005 when they came into the business, I can still remember the first board meeting, sat there looking across the table at my business partner Paul and going, what are they on about? Because they were asking us questions about the business that we've run and owned and we're really proud of, but it was all financial. It was all of the areas, which is why at that point we both looked at each other and said, we need a grown up in the room with us. So we hired a heavyweight FD. This is why the finance piece for me is so important, because these are professional investors. They're financial individuals. They look at instruments. They look constantly at ratios. They want to know what your covenants are. This is why, on Rowan's point, no surprises. We managed the relationship with those VCs from there on in as we did a customer relationship. Intimacy, no surprises. If we thought we were going to have a bad month, we would already be talking to them before the numbers came out. We'd say, it's on this is happening, you're going to see this happening. Here's the leading indicators that would tell us that actually the next month will be really positive. So we would manage that relationship really closely. And we did exactly the same when we did the MBO, or I did the MBO with bank debt. We did it with the bank as well. So the bank had no surprises, but they had absolutely uber confidence in our numbers. I nearly lost, well, one of the deals that I've been involved in, we lost because of the financial rigor. It just wasn't there. They said, we can't trust the numbers. As soon as that happens, forget it. It's just not worth going into. So having a robust management team that are confident in the numbers and that you can stop anyone from effectively looking at it and start going, I don't believe that. Because as soon as they start picking, you go down a rabbit hole and it then takes everyone off track. So definitely intimacy with whoever the backer is. If it's bank, get your advisors around you. Advisors will be able to point you in the right direction. They don't have to charge you. A lot of the advisors are looking for, sorry if I've just done someone out of money, but advisors will come on a journey with you as you go into a process. So they want to build a relationship with you, understand the business, and they will give you pointers on your hygiene factors, your company. Yeah. Because they want to be there when you say, right, I'm going to make this happen. And also the other thing I would say is, don't underestimate the time for a transaction. Transactions take time, and often they take time because people are wanting to see what your numbers are. So people will slow them down. If they've got some jitteriness around your numbers and hitting your business plans, the backers will slow it down. They'll just go, right, let's see how this plays out. Are you going to hit your numbers? You've put a plan in front of me. You've got to build my confidence.
James, can I just add to that because it's a vital point. The amount of businesses that we come across now these days at K3A who have the really strong commercial views, very strong business models, and they are ripe for investment from a commercial standpoint. However, they're not ready. They're not in the position from a financial point of view to take on the rigors of institutional investment. It's one of the reasons why I've moved out of the investment world and into the advisory world to assist founders in getting their businesses ready for a transaction, because for the best will in the world, you don't know what you don't know. Yeah. And having a a person who does know what is necessary, what is needed, is really, really, really helpful in terms of extracting value, because all you're going to do is leave value on the table. You'll still get the deal away, but you'll just leave a substantial amount of value where you don't need to do that. And I see this all too often, and investors are well aware of it. And that's why they have in-house operators who will come and post the investment to try and tidy everything up on the ground. And that's why having high quality CFO on your management team who understands institutional investment. It doesn't matter that they don't understand the sector. If they understand institutional investment, that is your primary tick in the right direction, and they're the people who should own the relationship with the investor.
Yeah, but let's be honest though. I mean, take a step back to this. All these things we're talking about is the same if you're a business not even looking for an exit. It's about making sure that you have absolute clarity around your phrase, Mike, the hygiene factors that drive your business growth. You know, and again, I use lots of words that you use because obviously you're in my board meetings all the time. But you know, do you know, and are you deliberately growing your business, or is it happening by accident? So every pound or every dollar or every hour of energy that goes in the top of the hopper here creates X amount of EBITDA stroke valuation at the other end type conversation. So I think anyone listening to this conversation, whether they are on the journey of an exit of some description or not, they're getting a dashboard in place of all the critical metrics and data and financials. So you can look at your business day to day and go, if I tweak here and tweak here, it will impact here positively, or vice versa. And I think that to me is so critical in this journey anyway. And yet it's a lot of recruitment companies we speak to just don't have that in place. They don't have a grasp on the data within their business. And Toni, do you find that because I know you advise lots of businesses as well now through TRN. Are you seeing that as well?
Yeah, I mean, we were lucky that we brought in a senior FD really early in our journey, which really helped me to understand all the finances. So we had really good financial management information and understanding. And at one point, we made the decision to build a company of value, to build that was capable of being sold should we choose to. And when I work with TRN members and other people at the moment, I try and get the same thing in place. Let's put in place everything that should you down the road decide to make a choice, because a lot of owners don't like to say, yeah, actually, I'd love to sell it, thanks very much. It's usually, oh no, I've got no intention whatsoever. So that's what we try to do. And yeah, definitely, I find I'm quite shocked actually at how many people don't understand their own finance. They don't understand their own results. You know, you ask somebody, you know, how well have you done, and they can't tell me how much profit they've made. You know, I would have known to the pound note how much profit I've made in my business, what my debtor days were. So I think that whole financial piece, getting that into your business early, is going to help you whether you choose to sell or not. It's just going to make your business better run, better respected, and it's going to make you sleep better at night.
Yeah, and for clarity, anybody listening in today on the TRN World platform, we've got loads of amazing content about understanding the financials and almost like your internal due diligence type stuff. So you know, feel free to reach out to member support or any of us on the call today, and we'll get that across to you to have a look at. Let's just go. There's a question I want to talk about, which is around entry points. I've written down this word entry point here, and I suppose there's sort of two entry points here, and it leads into a question from Mark Lloyd, which I'll talk to in a second. But the entry points around, I suppose, one for Rowan, one for maybe Mike and Toni. Entry point with regards to investors being interested in a recruitment company. Is there a certain level of EBIT that makes them, you're in the game? You know, we've always had this £1 million EBIT figure in our heads, which is once you hit £1 million EBIT, you're probably in the game and probably getting quite interested with a certain group of people. Much less than that, maybe you're a bit more of a distressed business looking to get out quickly. Much more than that, you've probably got a different group of people that you're probably attracted to or not attracted to, etc. So I suppose the question there really for me is, you know, at what point is the entry point to have the conversations, do you think, with investors and third parties and external parties? Rowan?
Yeah, I think the million mark is not a million miles off the mark actually. Generally, what we'd look at is, you know, the start of the private equity world. They're looking at anything from about $500,000 upwards. Okay. And the small cap investors are probably looking between. Some are doing $500,000, are looking at about $500,000, but primarily the small cap to lower mid market are anything between 1 and 2.5, maybe 3 million of EBITDA. And then anything north of that, you're going through to the mid-market private equity players, and they are probably looking at businesses that are between 3 and 6 or 7 million of EBITDA. Sometimes those are secondary, so they've already been through an equity round before, or they've been through a debt round before, and they're now willing to do an MBO afterwards. But anything from about, I think, 1 million to 2.5 is probably the starting point where equity is probably looking, and certainly debt as well. Anything before that, it's probably too early.
And are multiples still as resilient as they were a couple of years ago, or have they dropped off a little bit now?
Oh, geez, I'm probably not in the best place to answer that at this moment. I've been out of the investment market for a while, but they've probably cooled off slightly. If I just in terms of the general market, and at the moment there's we've got changes in political changes just across the globe, so that's also weighing heavily on markets and funding as well. So that will have an impact, a flow down impact that will come in the next 6 months to 12 months. That will come through to the private markets. We're starting to see it in the equity, in the sort of in the public markets. That will flow through to us in the next 6 to 12 months.
Okay, fantastic. So that's the entry point to go external. Mike and Toni, the entry point to start the journey of going down. I want to build a business for exit. Do you start that on day one? Do you go, I'm going to set up a business. I'm going to work out who's going to buy me. I'm going to create a business that's going to make me so attractive to them, they're going to come and pick up the phone to me type stuff? Or do you go, I'm going to do an MBO. That's my journey. So I'm going to build up that second tier team, make sure they're the right people in place to take over. So when do you start this journey? And for people listening on the call, there'll be people who are halfway through it, at the beginning, thinking about it, whatever. What would be your suggestion with that?
For me, I think it's one of the questions I ask anybody I work with, first of all, is why are you doing it? What are you aiming for? Where are you trying to get to? So I think having an end game in mind can start at any point on the journey. I think on getting to a situation where you are consistently doing £500,000 in profit a year to 750, and you've done that for quite a few years, and you've got a projection that you can get that quite easily up to the million, is a good time, I think, to start taking it seriously and putting things in place.
Mike?
Yeah, I mean, I would always start with the end in mind. Let's just remember, most of our businesses are owner founders. What does the owner actually want? What do they want out of this? Because there's a journey, our journey in terms of the initial point, 2000 through to 2005, 2007, there was a de-risking piece. I'd like to just take some money off the table. I'd like to make sure that actually I can capitalize on some of my entrepreneurs relief, those types of things. So what I often find is that people go to this whole, nth degree of I've got to exit. There are things you can do in through partial MBOs, exit, HMRC approval. You've got to go through that. But this is where advisors, if you want to take a cheeky £500,000 or £1 million off the table, there are ways you can do it if your business is of a size that can actually manage the debt. So there are different ways. EOTs, great for founders who want to de-risk. The next stage, though, in terms of value realization on EOTs, as I understand, it's quite challenging. But actually, for owner founders who want to de-risk to a certain extent, it's a good way to do it. So for me, this
Mike, in EOT, is that suitable for a small business as well as a mid-size? Or
I think you've got to be of a certain size. Rowan, you're probably better to answer that than I am.
Yeah, I'm not. You can do small businesses. So probably not the best person to answer. So I'm not so familiar with the EOTs from a size perspective. Small businesses can do it, but it's not like you can't.
Yeah. Well, to Mark Lloyd, I know you've got a question about that EOT stuff. I'll send you a link to some content we've got all about how the EOTs run and that sort of stuff. And we've got a couple of members who've been through it. So I'll share that with you. This is to Mark Lloyd, but anybody else listening into this conversation, if you want to copy that, let me know. So Mike, go back to you.
So I think the key thing on what Toni and Rowan both said is EBITDA is one measurement and absolutely critical, but the hygiene factors of the business, because actually, what is it going to be attractive to someone? You could park your tank of the lawn on someone's lawn in terms of one of your biggest competitors and become a real annoyance. And they just go, I want you. Okay. So I'm going to get that. You've got to have the right hygiene factors. You've got to have the right customer base. You've got to have the right niches. So I think EBITDA mixed with some of the critical hygiene factors, what you will find is that not only is a robust business, whether you just want to run it to earn good money out of it, or alternatively, you want to run it for an exit. So for me, it's all about, are we running a stable business that is backable, not only for my dividends, if that's what you're focusing on, or to get an enterprise value at the end of it. It's just looking at the basics. And multiples, yes, they have softened, but there is still good quality multiples out there if the business looks right and feels right. And they are looking at the key hygiene factors outside of just EBITDA. Because EBITDA can be shaky as anything, especially if it's just a pure play, high margin, permanent business.
Yeah, we had a couple of exits through the TRN members at the end of last year, actually. And one of them in particular, the business structurally wasn't amazing, I don't think necessarily, but my God, they were in such the right place at the right time. And it was just, that was it. And a big part of this is timing, right? So as part of that sort of process, I'm just conscious of time. We try and keep these to sort of 45 minutes long. So I know there's a bunch of questions coming through that we're going to sort of respond to afterwards. I think it'd be quite prudent for us. We've got some really cool documentation around those hygiene factors that drive up the multiple values, make your business more resilient, etc. So anybody on the webinar today, if you're interested and you want a copy of that, just drop me an email at james@therecruitmentnetwork.com and I'll ping that across to you afterwards. So you've got some examples to look at and we've got some guidance around all of those things. Just to our panel, thank you very much for joining us today. I know there's obviously lots more we can talk about. Just to sort of close off our panel session, just I suppose one final word of advice for somebody who's either starting out the journey, going through the journey, or probably knee deep in it and finding it probably a little bit hectic than they're expecting, a little bit more stressful than they're expecting. And Toni, I'll start with you if I may.
So I think just enjoy the process and just keep it in the day. You know, I think I found the hardest bit was sitting in front of everybody that worked for me for a long time, knowing what I knew and them not knowing it, and that did cause a bit of discomfort in the business. So I think it's a great journey. Know what you want out of your business. You know, the recruitment market is so up and down, even at the moment. I think you've just got to say, we work for a wonderful industry. Give it your best, but think about what you personally want. I think sometimes it's quite different than what we're saying we want in our business.
Fantastic. Mike?
Yeah, definitely. Enjoy the journey. Be clear on the outcome that you want to achieve. Don't spend the money until it's in your bank account. Simple as that. In all seriousness, I've found members who are already writing checks before a deal's done. Until the minute the signature is on paper, bearing in mind I did my last deal in the middle of COVID, so it was all electronic, it was all negotiations down to the last wire. You do not do anything until you have got clarity around what the next stages are. And then enjoy, you find out a lot about yourself. Be prepared, especially if you fully exit. This is an emotional roller coaster. It really is. And I think a lot of preparation, until it actually happens, signatures on paper, you're in a very different place. Then you find out lots about yourself because you go from having a mission to then having a void. And Toni sort of alluded to this earlier. The void is, what do I do with that time? Because you need to keep the old brain cells going. Get advice around you. That would be the last thing. Advisors beforehand, advisors afterwards. People who are there to help you and support you. Yeah,
and a big part of that advice, presumably, is don't be distracted on that journey so your business doesn't collapse as you're too busy getting sidetracked with all the other stuff that you're doing.
Sorry, just one very brief thing. I had a non-exec who supported me with running the business to make sure the business was in as good a place as it possibly can be. And I had an advisor that was advising me and supporting me around the exit, so that we made sure that we didn't take our eye off the ball with regards to numbers and how we were tracking as a business. And the advisor was then saying, are you running towards the exit? Are you making sure you're the right shape and size?
Brilliant. And Rowan?
Yeah, I mean, it's much the same sentiment. It's how do you eat an elephant? One piece at a time. If you break things down into manageable parts, that'd probably be my piece of advice. It is a long journey, but it doesn't have to be all consuming. It needs to be enjoyed. There will be some high times and low times. Just take it one step at a time.
Yeah, fantastic. So I think the sentiment from us, and it's been fantastic, really useful, guys. So I really appreciate your time. And again, we could probably talk for hours about all these types of things and go into a bit more detail. But really, it's about obsess about building a brilliant business. So then you have that choice. Don't obsess necessarily about the exit because it may never happen. But building a brilliant business can definitely happen. If you need any help with anything that you've heard today from any of the advisors or any of the experts on the panel, please reach out to us. We've got tools and guides and everything you need to support you on this journey, whether you're in the startup phase or you're going through to the exit process at the moment. So feel free to reach out to me or any of us on the call today, and we'd love to work with you. Love you to help you with that. Once again, Mike, Toni, Rowan, thank you very much for your time as always. Lovely to see you all. And thank you everyone who's joined us today live and those of you listening back to the recorded version. Really exciting year ahead. I think 2025 is a fascinating year for our industry without a shadow of a doubt, and a huge opportunity for the right businesses to create real and experience and realize real shareholder value. So make sure you're one of those organizations. Lovely to see you all. Have a great day. Thanks so much. And that's a wrap for this episode of the TRN podcast. Thank you for listening. And make sure you grab the free episode toolkit. All the links are in the description. And click follow in your podcast app so you can get notified of our next episode. If you want to get more out of your business and your people, then please unlock 30 days from our platform, TRN World, for free. And help yourself to all our training content, our guides, our templates, and peer insights. You can get started at trnworld.com/trial. And finally, if you found this episode of the TRN podcast of use, please share it with your network and tag TRN on any socials with your takeaways. Otherwise, message us directly if we can help in any way. We do reply to every question. Otherwise, we'll see you next week on the next TRN podcast.